past week. The weakening of the USD in combination with the drop of US yields allowed gold's price to climb higher. We expect fundamentals including the Fed's intentions as well as financial data releases such as June's US CPI rates to influence the precious metals price next week. In this report, we aim to shed light on the catalyst driving gold's price and asset future outlook. The rise of gold's price had become more evident on Friday as the market expectations for a possible worse than expected US employment report for June tended to grow. We have to note that the wider than expected drop of the NFP figure tended to disappoint traders exercising downward pressure on the USD, which allowed gold's price to rise. Yet, a cooler look at the data provided by the US employment report for June tends to show a mixed picture. Despite the drop, the NFP figure is still at rather healthy levels, and the fact that the unemployment rate ticked down to 3.6% tended to highlight that the US employment market remains tight. Even worse, the average earnings growth rate did not slow down as expected. On the contrary, it even accelerated, implying that the US employment market may continue to feed inflationary pressures in the US economy, which do not contradict the idea that Fed's monetary policy tightening is going to crack. To put it mildly, the tightness of the US employment market, we're saying that it has not done so yet, and that may allow the Fed to remain hawkish. However, on Monday, the USD tended to retreat further as Fed officials proceeded with statements regarding the Fed's intentions. There were more mixed signals as Atlanta Fed President Bostic stated that a pretty straightforward case seems to be building up that the inflation is to return to the Fed's 2% with no further rate increases. On the other hand, San Francisco Fed President Daly stated that she believes that 2 more rate hikes are needed this year to bring inflation down, while the more hawkish comment came from Cleveland Fed President Mester, as she stated that the economy has showed more underlying strength than anticipated earlier this year, and inflation has remained stubbornly high, with progress on core inflation stalling, implying more rate hikes are required. Yet the market had already priced in another 2 rate hikes to come, and the possibility of the Fed ending its rate hiking cycle afterwards was enough for the market to sell the dollar and thus allow gold's price to rise, something that became even more evident on Tuesday. In the coming days, we expect gold to maintain its negative correlation with the USD, and any further weakening of the USD may allow gold's price to rise. As the next key event for gold, we highlight the release of the US CPI rates for June tomorrow, Wednesday. Currently, the headline rate is expected to slow down on a year-on-year level as well as on a core level, while it is expected to accelerate on a month-on-month level. Overall, should the release show that inflationary pressures tend to ease further, that may allow the USD to weaken as the market's expectation for an easing of the Fed's hawkish stance could intensify. Such a development, very much like the release of the US employment report for June, may allow gold's price to rise. On the flip side, should inflationary pressures remain stubbornly high, we may see the USD gaining and gold's price dropping. Thank you for watching.